the investments and head investment services at InCred Wealth. Today, we live in interesting times, and to make our lives and investments simple, it's always good to get insights from the market wizards. And in our endeavor to get clients to meet, engage, and with great minds, money managers, we'd like to introduce Samir Arora. So, Samir is a very familiar name, and I'm sure most of you have followed him and heard him on CNBC and the various channels on the business side. He's longest career in investing, 29 plus years, and 16 years at now Helios, where he runs his own fund, always based out of Singapore, and has a long short fund there. And now Helios is in India for some time, and we have a option of investing through him. We've been hearing him for a long lot of time, and now we have a choice to invest with him and benefit from his expertise. So without wasting too much time, I will let Samir tell us more about the markets, his views, his style of money management. Over to you, Samir. Thanks for.
Thank you, everybody. If you can make me the host so that I can use my presentation. But hello, everybody. So what I'll do is I'll just make a little bit of a sort of a canned presentation on what we do and how we have done it so far in our life. And then we can talk about the current market situation. But before you start believing what I say, you must see what we do in our history. Because being on CNBC is good, but that is like, I met one guy while part of this marketing, and he said, no, but I know you are famous. So I said, famous ki baat nahi ho rahi, kaam karne ki baat. You're famous to Mr. I can't use that name publicly, wo bhi hai. So the point is that, let me just show you beyond CNBC for a
minute. Radhika, yeah, you managed. It's perfect.
Yeah, okay, so just to give you sort of a big picture background of mine for people who may not know, that I seem to have India's longest track record as a public markets fund manager. That means anybody in the mutual fund space or PMS space or anybody not managing prop money. So how that happened is that I'm from IIT Delhi, and then I went to IIM Calcutta. And because in the 1980s, there were no real finance jobs in India, I decided to go to the US to study at Wharton School, but basically to do a PhD in finance because I was already an MBA. There was no point in doing another MBA. So I went there, but while doing a PhD, I realized that is too academic for my purposes. And while doing that, I applied for jobs and I got a job with Alliance Capital, which was at that time US's 9th or 10th largest mutual fund company, 8th largest. And I got a job, and I therefore at Wharton didn't complete a PhD and MA Finance instead. So I joined Alliance in June 1991, and the Indian reform started in July 1991. And therefore, from day one, although at that time I was not formally doing India, but because I just joined and I was an Indian, and any opening new market, all these emerging market funds want to learn about. So I was tracking that sort of separately. I was actually an analyst for Asian markets and Japan, a few sectors. So in 92, there were some more reforms related to the market, which were related to opening the mutual fund business to the private sector and opening the FII concept. And because of that, I moved back as Alliance's first employee and more or less any company's first employee in India in 1993. And because unlike other guys, I continue to manage India dedicated funds, I now have the longest track record in the world for India. We did well in those Alliance days. I had not been a fund manager for a day before. I had not even been an India bottom-up analyst for a day before I started actually managing money. But I beat the market by some 33-34% per annum for 7-8 years. And the summary of that period is that by 2003, Alliance Capital became India's biggest private sector mutual fund company in equities. We were much bigger than HDFC and ICICI and all these guys who had huge domestic brand recognition and name and a global partner. We just came in from the cold, no Indian partner, no local knowledge, no local office, nothing before. And we did that, and those was my glory days. So since then I moved to Singapore in '98 and became head of Asian markets. And from 2005, along with at that time the chairman of Alliance Capital and the chairman of Alliance India, we've been running Helios. So I'm the founder of Helios Capital, which itself now has a 16-year history. Helios is registered in Singapore and has, whatever license here, which is called Capital Markets License. And we are registered with the SEC, and we run an India dedicated long short fund. And we also run a global fund which invests actually in the US markets. And for the last, in 2019, we got approval for, or maybe early 20, we got approval for doing PMS and AIFs in India. And this is why we are here today. So the other founders are Dave and Karan. Karan was the chairman of Alliance India. Both of these are not employees of Helios. They are shareholders and directors of our offshore fund. We have currently 21 people, 7 in Singapore and 14 in India. But the investment team itself has, India team has 5 people. And if you see how all of them, other than Gaurav on the right, 4 out of the 5 very, very experienced, with more than 27, 28 years experience each, which is the longest experience that you can find on India investment professionals, because basically everybody joined this industry. I mean, the most senior guys joined this industry in the 92, 93, 91 period when professionals were basically joining the industry. And it is very rare in our business to have people who are so senior all working in one company, because generally the idea of each guy is that I want to be the boss and I want to be the head of the business or whatever. But here, effectively, although they have these fancy titles, effectively everybody is an analyst and I'm the portfolio manager. So just to give you some this thing on our performance, this is my historical performance. The bottom 4 funds are alliance funds, and the top funds are the Helios funds, and not including the PMS, which as of today is up some 75% since inception, which was middle of last year. But that is, the whole presentation is of that. So let's talk about the other funds. So the bottom fund you can see here, the alliance funds. And on the top left is the Helios Strategic Fund, which is the long short fund that I manage. And unlike the bottom fund, which are in rupees, that is a dollar denominated fund. And therefore, in dollars, although still we are up some 710% and the market is up 328 in rupees, it looks even more dramatic. The second fund, we were advisors to ICICI Prudential Asset Management for 9 years in a PMS offering, which was actually an ICICI product, and Helios was the advisor. And basically, that PMS had the long side of our long short fund. In India, we the PMS and the AIF, we are planning or are doing right now only long-only fund, long-only strategy, rather than a long-short strategy, which I can explain why. But basically, that the market was up 92% in those 9 years, and we were up some 260%. And at the end of 19, SEBI came out with a rule that PMS companies cannot outsource their research. And therefore, we decided that we will do it ourselves. And that is why from 2020, technically March, we started Helios PMS, which is the same thing as what we were doing in the advisory mandate, which is broadly speaking one portfolio across the firm, and then a little bit of variation depending on cash flows and a little bit of that might be available to each of the 2 funds. So just to dramatize this, then we'll come to the strategy part. Here, what I've done is taken the Alliance Fund, longest fund, which was the equity fund, and the Helios Fund, and converted the Helios Fund to rupees, because everything else is in rupees and we are comparing it to benchmark in rupees. And for the period between Alliance and Helios, I have taken index as my performance, as if I was able to at least get index performance. Even during that time, and even after I left Alliance, the Alliance funds outperformed the market. During this period, when we say that in theory I did 102%, the actual fund was up, it's written in the notes below, 124.01%. But let's just take it as if I got at least index performance, or we can show both my performance and the index performance. But basically, over this 25 years, the market is up 22 times. And other than for this period where I assumed index performance as my performance, everything else is actual. There is no back testing. It's not a model portfolio. It is not like another PMS guys in India who have 2-year history, but they say if they had bought the same stock 20 years ago, what would have been their return? This is otherwise 100% my performance. My performance would be up 301 times. And I dare say that many of the prop investors and many of the billionaire prop investors over this period would have a lower performance than what our fund has had. Now, our fund has had 30, 35 investments. There's a limit of 7.5% on the top name. There have been inflows and outflows, and how we were able to get 300 times while the market is up 22 times, and where during this period less than 30, 40 stocks may have gone up 300 times. How we are able to do that, that is our story and our sort of mini claim to fame. This last one before that since we started Helios, nearly every year we've been nominated for the best India fund by Eureka Hedge. And this,
Samir, hi, sorry to cut you. Can you speak a little closer to the mic? Voice is not very clearly.
Was it? Okay, I was actually speaking in this, so maybe it's not working or what. Okay, I'll try and speak louder. So this is the performance, not performance. This is from the Eureka Hedge. Our fund started in 2005, that's Helios. And nearly every year since then, we have been at least nominated for the best fund. We have not won it every time for sure. But the fact is that the churn at the top of which fund is winning is so high that if you can be constantly somewhere up there, then you tend to outperform everybody over the long run. And our endeavor has been to have consistent performance relative to the market every year, and not have a performance of the style that you underperform for 3-4 years and then do very well for 1 or 2 years because either the mid caps are back in favor or quality is back in favor or cyclicals are back in favor. And even though you may over the full life of 5-6 years massively outperform the index, I have felt that I would rather do it more consistently, even if in the end it's 0.5% less more than the other guy, although we've never had it less, because investors don't come precisely with the schedule of your outperformance and the underperformance, and you want everybody to have similar and good experience while investing in your fund. So let me now tell you the strategy and the philosophy part. Some parts are very different from what others may do, and some are obviously the same style. So the thing is that when investors are building a portfolio, they spend, or even a fund manager, they spend the maximum amount of time logically on which stocks to buy. And that is, of course, very important. But it is not the only thing to be done when you are building a portfolio. You have to know, for example, how many stocks will you own? And that needs some logic. It's not just that either I am concentrated with 10 stocks or I have 50 stocks. There has to be some thought behind it. I'll explain. The other one is that when you're buying a stock, are you straight away looking for a 20-year winner and a 10-year winner? And how will you even find that? Or will you do 3 to 5 year type investing and then move from one phase to the other? And then when to sell? So on which stocks to buy, our simple difference with the others is that we don't claim any, we don't claim that we can find 5 and 10 years ahead of time that which stock to buy, but we can start by saying which stocks not to buy. And the logic is as follows, that if there are 100 stocks in the market, let's say, and therefore the index is an average of these 100 stocks in terms of performance, weighted by market cap or whatever, that you can get to the same thing by either saying I'll buy the 20, 30 best stocks, or by saying that I will not buy the 50, 70 worst stocks. Because it is easier to define what is bad than to define what is good. So for example, an employee who steals money is bad, but an employee who doesn't steal money does not make him good. You could say that for companies also, that an employee does not steal money from minority shareholders, big deal. You're not supposed to. But if you do steal, you are bad. For example, you could say that an employee delivers results as expected of him, does not still make him good, because he may be stealing money. Whereas if he does not deliver on his results. It doesn't matter what else he does, he's bad. So, like that, it is easier to take 1 or 2 points and reject a company than to say, I will study this company for 50 years and I will analyze it with 50 questions. And when 50 questions are, I am convinced, I will suddenly buy it, because these things you can never have high conviction 10 years ahead of time as to, for example, we bought Bajaj Finance in 2011 or iShare in 2009 or Kotak in 2002. At that point, you don't know that it is going to be good or that it is good. You know that it is not bad on any of the factors that we use to screen. And then from the stocks, as we say, which cannot be rejected on any factor, we will take some bets, either more or less, depending on whether they are coming from the same sector or from the same thing, where some comparison can be made even within them. So then normally the 8 things that we believe are associated with a good stock or a good performing stock are generally that it comes from a good theme, that it has a favorable industry dynamic, that there is less potential for disruption, which is a new factor we've added in the last 1.5 years. That it has strong management, it has good governance, that it has accounting clean, it has some trigger, there are reasonable valuations. But the reality is that we are doing it completely opposite. We are saying if somebody doesn't have reasonable valuations, he's out. If somebody doesn't have clean accounting, as can be seen for the moment, he's out. Sometimes you have to do trade-offs. If he does not have a good history, he's out. If he does not have this thing, that is out. Whatever is left, we don't know whether he's good, but he's definitely not bad. And that is a massive, massive, massive reason for our consistency over the years. And so we say that there is value in differentiating between good and bad. And I'll explain in another slide how good that uh, differentiation is enough to make massive amounts of money. So in terms of the first thing, which was the theme, which we say that if stocks fit this theme, then they will not be rejected on theme ground. And otherwise they may be rejected. But unlike theoretical fund managers, because now over the 25 years we become practitioners, we never say nothing is a no forever. So in reality, about 85 to 88% of our portfolio is in the themes that we like. And we still have 10, 15% in themes that we otherwise say we would use to reject a stock, because it is not that the market will wait for my themes. Sometimes we say we don't like PSUs, but something may happen to a PSU and stuff like that, and we may buy once in a while. But broadly speaking, these are the 3 themes that we have preferred all our life, where we will prefer them for many, many more years. So first theme is to go into sectors where government companies are large competitors. This, I believe that I was the creator of this thesis, because that is how from 1995, I've been owning HDFC Bank from its IPO days, both in Alliance and then Helios, and personally in 96. And my story came in a book called Bank for the Buck. And the same logic was used then, which is that the government has privatized India by privatizing sectors, but not by privatizing companies. And that is what gave enormous opportunity to companies like Alliance Capital and all these private sector mutual funds, as they competed with UTI and all these banks, as they competed with state-owned banks, Bharti and Z, where all this money we made all our life. So that theme today is reduced to private sector financials, because that is where there is still some market share to be taken from state-owned companies, and we like that. The second theme we discovered in the 90s, and we still run with it, is that we really don't need to go for 1.3 billion consumers. Because if you divide any sector size by 1.3 billion, everything looks very attractive, even though these people are not economically equivalent, and it's much tougher game to go to the world. And since we are investing in liquid assets or in equities, we can go to the most attractive part of the market, which is if we believe that this is underpenetrated even in urban India, or in middle class India, or in the 300, 400 million population India, because that is easier to compare economically with other countries. Plus, you can imagine over time that this pool will increase, and therefore this thing can go on for a longer time. And the third theme, because we are a product of the 90s, We were always heavy on software. And over time, we have chosen sectors that look like software, which is pharmaceutical and specialty chemicals. So, in plain English, our preferred themes are private sector financials, urban consumer, and tech pharma, specialty chemicals in most cases. But today, for example, we say that we don't buy state-owned companies and we don't buy 1 billion consumer stories. But State Bank of India is one of our top, I think, second largest. So once in a while, we will go out of our theme because, as we said, we are not theoreticians in that sense. Our one more theme that we don't like is we say bet on India, not on Indians. So we will never buy a company like Tata Motors, which is really not an Indian company. It is a foreign company listed in India, owned by Indians. And we don't understand the opportunity and we don't understand the competition and we don't understand what valuation should be of a company which is listed in India but competing with a Chinese company and a German company and all that. And so we don't care. We say bet on India, not on Indians. We don't want a company with a very big business in Africa because in Africa businesses are available at 4p or 10p and you list them here, they are available at 40p. We don't understand that. So we just do our simple stuff, which is these themes most of the time. And then we have these other factors that we use to try and reject. Life is not that straightforward that you can reject very easily because there are trade-offs that you know that the accounting is a little bit off, but what to say? Every company is not a Yes Bank or a DHFL. It is just shades of gray. And we say, oh, you should reflect true cost of foreign exchange debt. You should not capitalize some of your general expenses. But if you do once in a while, you may feel like rejecting them so blindly on one factor, but in reality, it is not. So, but we are just, the idea is to show in which direction we are approaching. We are not, for companies that are relatively, I'll explain that in the future slide, but broadly, the idea is that you reduce the universe from 300 to something like for us, 120 names, which we say cannot be rejected on any factor. They can't be rejected on having a bad theme or bad governance. But you don't know how good they are, but there's nothing bad that you have found. They are like in the good part of the market. And then if you may be left with 10 tech companies or 5 pharma companies or 7 consumer companies, you can then do more one-to-one comparison to see which ones are better. But you will still have 50, 60 companies that will look nearly same to you, and then it is left to how each company reacts to the environment. And we buy 30, 35 companies, which I'll explain later. That is the big picture idea of the process is working. So the next question becomes how many stocks to own? I already told you the answer. But this is a big debate in both India and the world, that should you have a concentrated portfolio to make wealth, and should you have, if you want to make wealth, you should have concentrated portfolio, and you don't know what you are doing if you are not concentrated. And this is complete nonsense of the highest order, because the assumption in this is that only some 20, 30 companies make wealth and the rest of them are just born losers who will disappear after some time. And this has to do, the fact that a large number of companies do well has to do with arithmetic. It doesn't matter which country, it doesn't matter what period, because the logic is, I'm doing with US and come to India. If there are 500 companies in the index, I mean the NSE 500 index would not have mattered. It can never ever be the case that 20 companies do better than the index and 480 companies do worse than the index, because the index is an average return of these 500 companies. So generally, plus minus at the 250, maybe 200, maybe 220, sometimes 280 companies, depending on whether the market is very broad in its performance or sometimes very narrow when some large companies do well. But it will never ever be the case that when you're calculating an average of a large number of companies, that the one side will be 20 and the other side will be 480. And you can see year by year how many companies out of the S&P 500 beat the S&P 500. And that number is 234. In a very narrow market, which means very few companies did well, was a year like 2020, where suddenly Amazon is up 80% and Apple is up some 70, 80%. And these are large companies with large weights. And even then, you could have chosen any of 168 companies and you would have done better than the index. So if some on average 200, 225 companies, just 40 odd percent of the market does better than the average, then by definition, if you go to 30%, they will do even better. 20% will take the pants off anybody. But look at the performance of the 30%, which we think is good. Look at the 150th best performing company each year and compare it to the market. And you will be blessed if you could have even had your entire portfolio invested in the 150th best performing company, not out of the thousands of companies that are listed, but out of the 500 companies that are the biggest companies and which are constituents of the S&P 500. If you could have only taken your companies and been able to say, is it in the top one third of India, of US? Is it in the bottom one third? Don't have to say, is it the 10th best company in the world? Is it the best thing since sliced bread? Is it some Asian paints? Who cares? The point is, if you could have even done, is it the 150th best company of the market? Each year you would have done 1830%, while the market is up only 331%. For India, it becomes totally wild because India is such a wild country in terms of volatility that if out of 300 companies, which is our universe, you could have only said, which is the 90th, is it in the top 90 companies? Forget about is it the best company of India? You would have been up 57 times. Your return would have been 5,509. And there is no theory behind it. I mean, what I mean is there is no formula. There's not some table. These are actual numbers for the last 16 years. It is not that we have made it on an Excel sheet. These are actual what happened in the market. The point being, at the beginning of the year, you will never know that suddenly Dixon Electronics is going to go up 300% this year, and India Mart will suddenly go up 200%, or that Bajaj Finance is going to go up 70 times in 10 years. You will never know because they don't know. I will show you some examples because the management also doesn't know. All we know is that a large number of companies do well. Then mostly companies that do well have good themes, good sectors, good management, good history, good governance. Sometimes even bad governance will do well. But most of the time, good governance, good valuations will be doing better. And we are therefore removing stocks that don't fit that and hope that what we buy suddenly comes into stocks that do very, very different from the market. But at the beginning of the period, you are going to say, I know HDFC Bank very well and Kotak Bank very well, but those stocks are not going to be suddenly up 67% while the market is up, as you can see, 18% that year or something wildly different from this thing. So our theory is as follows, but before that, last time, we own HDFC Bank and we own ICICI Bank. But if we look at it from the day we started our fund, HDFC Bank has been there forever, and HDFC Bank is up some 22% per annum, and ICICI Bank is up 15% per annum. So we can all say great things that, for this entire period of 16 years, HDFC Bank was one of our top holdings. It has massively beaten ICICI Bank. But suddenly, if you see it in the past 3 years, HDFC Bank is up 11% per annum, but ICICI Bank is up 35% per annum. You have to think of all these things in building and constructing the portfolio, which I'll show you. But before that, one more example. So we were the largest investors, or one of the largest in the IPO of Page Industries when it happened. And from that day to today, although we don't own this now, but the stock is up some 38% per annum. It looks so, wow, great. Page Industry should be bought. It gives 38% returns per annum all its life. But if you look at it for the last 3 years, Page Industry is up 3% per annum and Jubilant is up 32% per annum. And you have to be able to move somewhere, not necessarily every time precisely at the bottom. Or otherwise, the market, as I said, did not have even 30, 40 stocks that were up 300 times in the 25 years, and our fund was up post expenses, is because every now and then you had to move. So we say there are two kinds of stocks that you should have in a portfolio. One is stocks that offer a high confidence, but when they offer high confidence, the returns cannot be high because your confidence comes from the fact that previously they've been giving high returns in most cases, that they are steady performers, that their management is good, that their history is good. In today's context, it be HDFC Bank, Kotak Bank, PCS, But when they started, when Kotak Bank in 2002 was not even a bank, it was actually a broker. How would you have bought it then? You could not have said you have high confidence because you don't know whether this broker will become a good banker, whether he will be influenced by some industrials, he's a partner of Mahindra, God knows what he will do. You have not seen his corporate governance, you have not seen his capital allocation, you have not seen whether he issues too many options to his friends, whether he lends to good sectors, bad sectors. Suddenly today they come and say, wow, it has got good management. But we have had it from those days because at that time we never called it high confidence in reasonable return. And those days they were reasonable confidence in high return. Logic being that the stocks that are well known, well understood, you will mostly make market plus a few percent. Because the whole market is there and you're saying these stocks have some, of course, good history, good market opportunity, and there is still room to grow, etc., etc. And these are the stocks which in today's context, I told you, Kotak Bank or Dr. Reddy or HDFC Bank or something like that, where you don't expect the stock to be re-rated. You just want the earnings to be given to you without losing on the valuation. But then there are companies which are at 70 and 80 multiple, and it is possible that if their earnings go 20%, but the multiple suddenly from 70 becomes 65 and half your returns are gone. So from that universe, you choose a few stocks. We say 10 to 15 stocks, 50, 60% of the portfolio. But the second group is a group of stocks where you did not find anything objectionable on those 8 factors. They were good on all those. I mean, they were not bad on any of those factors. And then on some things, they were better. There might be a trigger, like we had Dixon, because there was a trigger that China plus one strategy might work or make in India might work. At that time, there was not even a discussion of PLI scheme and all these things later. We bought Bajaj Finance in 2011. We don't own it now. We sold it after it 70 times. But in Bajaj Finance at that time, there was nothing good that you could find. All you know, there's nothing bad. There are new guys. Rajiv Jain has come. Bajaj is a good promoter. But it's not that you ever thought that suddenly these guys will become a 50 billion market cap company. But it was worthy of a 2.5% position, saying it doesn't look bad. And they were doing some new things related to financing with non-Bajaj scooters and all that, and you say, okay, they might go 5-7% higher than others because they have still not gone into the possible segments or sectors that they can go to for financing. So the second group is what we call reasonable confidence and high return, because we also know that a large number of companies do well, broadly 1/3 of the market by mathematical reasons. And therefore, when I buy 15, 20 companies, I'm hoping that some of those companies become the big hits, while the upper part gives me the backbone and the steadiness. So in the second group in today's context, you will hope to make some, I don't know, maybe 25% return, and in the top stocks, maybe 15, 17% return. And then you mix everything and depending on what the market does, and you get. So we also believe that there is no way you can predict for 10 years what will happen. We have owned stocks for 10 years, but we never imagine at the beginning of that period that these stocks will be good to be held for 10 years. We are buying them with a view that we can analyze. And then if they continue to do well, we will continue to hold them. But you can take many examples. You can say Steve Jobs, he died in 2011. And when he died, he did not know that in 2020, Apple will be a $2 trillion company. 80% of his net worth was in shares of Walt Disney when he died. Bill Gates, yesterday, the market cap of Microsoft briefly touched $2 trillion. But you would have read recently that out of his 125 billion net worth, he has less than 20 billion or 25 billion, definitely less than 25 billion in shares of Microsoft. And what has he done by selling Microsoft shares? He's bought whatever else he's bought. But Microsoft has been one of the biggest movers in the last 5-7 years. Obviously, Bill Gates didn't know it because nobody knows beyond a point what opportunities will come, what the next CEO, which in this case has become a big hero, our Indian friend in Microsoft, that all these guys, how well they will do. But you can see them 2-3 years at a time and then move or not move. And that has been the reason for our flexibility and for our track record which is higher than what individual best performing stocks may have got. Because, for example, in the period 98 to 2000, Z was up 100 times. We were not speculating on Z in 98 because we knew that in 2020 this company will be disrupted, but I'm still owning it. We were owning it at that time because it looked appropriate for that time. Now, if you look at the winners for 20 years, their Z's name doesn't come. But you please look at it from 98 to 2000, it was up 100 times while we were holding it. Although we were selling, of course, every day, literally, because of SEBI rules and even otherwise. But the point is, so Aban Lloyd, which is now a bankrupt company, from 2004 to 2007 went up more than 100 times. And we made maybe 6-7 times in it. But in 2000, we bought it in 2005. We were not speculating. We were not gambling. We were not saying we know that in 2020 this company will not exist, but still I want to buy it because I'm just a speculator. In 2005, it looked like a fair bet for a 2-3% position. And it kept doing well. We kept trimming, but we kept holding. And then one day we sold it off. It had gone up maybe 5 times before, and it went up 20 times after we, 10 times after we had sold. But there are so many of these which you will only get if you broadly believe that 1 to 3 years is a decent holding period. And this 20-year holding period happens in increments of 3 years for some of the stocks that in the end turn out to be so good, but you're not going in with that view. And for when to sell, we are very clear that when to sell is when in the first group of companies which are already highly valued and you're buying them only for earnings, if they get further and further and further and further re-rated. So that when companies in 2010 started with 25 and 30 multiple and today are trading at 90 multiple, where the earnings growth over these 10 years is 10 and 12%, but the stock price growth is 30%, then at some point per annum, then at some point during that period, we have sold many of these companies. We have sold Aisha, and we have sold Page, and we have sold Nestle, and many others, because the stock price appreciation is higher and higher and higher without any underlying matching earnings growth, and there is a limit to which it can happen. And the other, of course, is if there is some deterioration fundamentals, we will sell anyway. But the idea is not to rely totally on a handful of stocks, because as we say, high confidence does not come with high returns. High confidence basically means that everybody, because it's very rare that only you have confidence, and high confidence basically means that the stock is well discovered beyond a point. So now we have launched this Helios India AIF, or we will be launching tonight or whatever. But we already have a Helios India Rising PMS, and it will be identical, nearly identical to this. So just to tell you about the current weightage in our PMS scheme. So if you see here, our this is as of May 31st. These are the sector weights, and why there is a 92% weight and a 99% weight is because we have a large number of STP investors in this, which is systematic transfer plan, and those guys are in cash till that money gets invested. So the overall portfolio looks like 92% invested in equities. But for somebody who says, I don't want to do it in a installment fashion or STP fashion, mostly we invested. And for those guys, it is 99% invested. And this is the current performance of our new product. So again, we have broadly beaten the market by 5-6%. As of today morning or today evening, it is up some 74%. Because this month we are up some 3-4%, which when you multiply it with 1.6, it makes it. So broadly, this is the thing which we are now doing in an AIF format. And I will take any questions. And this is just a sort of a summary of our history, because many people may say, oh, there's so many AIFs, so there's one more AIF. There's a big difference. First is that we have an actual track record of 25 years. We, as in the management of Helios and the Singapore guys, have more than 300 crores invested in the same stocks that will be bought in the Indian thing, because it's going to be more or less the same stocks. We also manage a long short strategy, although we are not shorting in India, but it gives us a different angles, and our effort And our research, therefore, is much deeper than just somebody buying 10 stocks and holding them in life. And we also manage a global fund, and therefore there is more insights on what is happening and what can be copied from the US market. Plus, unlike new AIFs, we have not created this team today from different companies to say now we are trying to do a fund, because the ego issues between analyst and fund manager, or the style of working between the research team may be different with different backgrounds. We have been basically, whatever we have presented has happened at least in the last 16 years with the same team. It is not a new creation, which sometimes don't work when the egos of individuals hit each other. So that is our history, and now I'll be happy to take questions.
I'll request participants to type in their questions in a Q&A box or the chat window, Q&A box or something, and we'll pick it up and we'll ask Samir the same. Samir, to start with, while we gather questions from the audience, to start with, everyone's focused on the COVID era and post-COVID and worried about the third wave, second wave, vaccine working, not working. How do you take this as an opportunity or
So
mixed?
this one I knew will come. So I have one this is on energy,
Standard
which
question,
I was
right?
about to do it, and then I realized that you haven't asked me because that is my okay. So big picture, then we'll come to COVID. So this is from 96 March, since I've been investing as a fund manager. Before that it was a balanced fund. So 96 was the equity fund. So this is the comparison of the Indian market with gold. We could not put fixed income in it. So the first point of this slide, then comes the next one, is that broadly speaking, all the time, investors' money is to invest it somewhere. Your choice is Indian equity, Indian debt, maybe a little bit foreign equity, but gold, real estate, etc. And it is those relative choices which drive markets. Right now and forever, the markets, equity markets over a longer period give better return. There is no question about it. The question becomes, have you come in precisely at the wrong time so that your 3-4 years are wasted? Like it happened, say, if you came in December 31, 2007 for the first time into the market, then although you may say equity beats debt, it'll take that fellow's investment 5 years to recover. So I can first show you what all I have seen while my NAV was up 310 times, assuming those things that you say Alliance plus Helios. So we have seen every event which is worth a 10-15% kind event, including a government that fell in 13 days, which was Atal Bihari Vajpayee. We have seen Asian crisis, Russian crisis, global crisis, financial crisis, attacks on parliament, sanctions of US put on India in May of 1998, Kargil, Demon. Demon is as big as any COVID, sir. It is one of the worst economic decisions ever taken in the history of any country. So these things have all been handled. So in a big picture sense, we can say that your timing might be a little bit off, little bit here or there, but in general, this is not your first and only investment that you will make. If it is an ongoing thing where you're first investing in some asset, then I mean somebody's fund or your own equity, then so it is part of an ongoing thing. But if you say precisely right now, I would say it is not. The confusing thing is that when you look at 1 year performance, the numbers look very wild. That you're up 80% or 90% or that, and therefore it looks you're coming at the top. But let's break it down calendar year by calendar year. So in 2021, the market is up whatever 13-14% or whatever. 2020, how much it was up? You remember, Yogesh? Full calendar year.
2020, you said.
I mean, last year.
Last year.
Calendar, because I do calendar year, I don't do a fiscal year.
It has been negative. No, actually positive.
It's about 15-16%. If you go to 2019, it was up some 9-10%. If you look at 2018, it was down 4-5%. If you look at 2017, it was up some 35-40%. Again, 2016 was 1%. So generally, the returns have not been wild to say that this is the end. If you look at what happened in 2007, in 2000, because we started in 2005. So 2005, I think the market was up some 45, 50%, although we came half through the year. 2006, it was up 50%. 2007, it was up 80%. Before that, 2004 also, it was up some 20, 30%, if I remember. So broadly, this is not some wild in that sense. The second thing is that there have been massive difference in winners and losers. That is true. Some sectors are being disrupted and blown out. So all in all, who knows is the answer. But broadly speaking, the history is that equity markets do well over time. Here you can say there's a cyclical recovery in addition because from a lockdown to an unlock and the world in synchronous and money printing and all those things. So right now it doesn't look bad. Again, we come back to what we say. It doesn't look bad, but it's not the hottest thing since sliced bread was invented. It's like a normal market. It should beat a normal other alternatives. And in today's context, reasonable return from the market will be 13, 15%. Because it can be related in two ways. One is the nominal growth of India and plus minus a little, because there's no real re-rating that will happen. And the second you can say is that what is the risk premium, which means how much will equities make more than fixed income of the same country. So there I have some book in which I read, the book is called Triumph of the Optimist, for 16 countries for more than 100 years. The difference is around 6%. So Indian 10-year is some 6, so you add another 6 and then you add another 1 or 2 because you are more bullish, less bullish, or you choose something here, or because the index does not represent agricultural sector as much as it reflects some global companies or whatever. So you can say 13, 14% is what the index should do. And then good fund managers should beat it by a few percent, maybe 3, 4% net of all costs. We have in the past beaten by 30 also, but who knows? 4 or 5 would be a great
Yeah. So I think you answered a part of that question on the index levels and where is it headed and why. I mean, one should look at because of the relative opportunities compared in the fixed income space and other asset classes. Why equity should make sense and it should give a reasonable return. Other point and question which I have here on the Q&A box is on the valuations piece and what do you think the valuations are at all-time high?
People are, yeah. And I'll answer this question on the performance 1 second because we have it there. So if here you see our day one investor is up 68 as of this date, whatever, May 31st. And the portfolio, which is what you see as a overall portfolio, is up only 58, whereas the index is up 64. So it looks that we have underperformed, our PMS has underperformed the index, but it has not. This is because we have 40 to 50% at various points STP investors, which means people who did not choose to invest but gave us the money. And how you can see that is by looking at the cash exposure that we show in the box below. So for example, if you look at periods like August 2020 or September or October or November, our fully invested guy was fully invested because he did not choose the STP option, and that was 97% and 100% invested. Whereas the consolidated equity exposure was 75% in September 20, let's say, which means the the guy who wanted to wait was actually maybe sitting on 50% cash. So now this is more a way of explaining or understanding. But as far as we are concerned, if the investor says give money in 5 months, he gives money today, but he wants it invested in 5 months. And we are sitting on 80% cash and then 60% cash for him. It will underperform in a rising market, but for the guy who chooses to fully invest or the invested part of the STP guy has outperformed by 5-6%, and our index here is NSE 500. Now, what was your question? Sorry.
Yeah, on the valuation.
So the way to look at valuation is look at it in 2 ways. One is that valuation in absolute is not the right thing to do because the valuation has to be compared with interest rates. There is no discussion on this topic that you can't say today is 25p, last time it was 25p, so it is the same. Because that the discounting, the flows are all happening because of interest rate. But look here, so there are two ways of doing it. One is to look at what the foreign investor has chosen to do while he had the option of doing whatever he has the option of doing, right? So you look here, first of all, on the box on the left, top left, is the premium discount since 2004 of Indian valuations to Asia Pacific. Now, India has always had higher valuations than the region. That you can see from the premium, it went to 50%, 50, 57%. Right now, it is sort of at the mean. So why are Indian valuations higher than valuations for Korea, Taiwan, Philippines, Malaysia, etc., whatever, because it's Asia Pacific, ex-Japan, is that basically Indian company mix is very different from Asia typically. So for example, if Samsung Electronics is there in Korea, which is some 30% of the index, its multiple is something like 10 or 12 because they have to invest 15, 20 billion dollars per year in R&D and capex, and then they find whether it has worked or not worked, whether their chip has worked or their LED thing has worked or not, and their capital returns are very low. Similarly, TSMC, etc. India has had software which is very, very high valuations because it is a different business. Similarly, India has more than 150 or 125 multinational subsidiaries listed in India. Not a single other country will have more than 2, 3. Indonesia might have some lever, Indonesia and all. Otherwise, because India forced these companies to go public, and others didn't, we only have Indian MNCs listed in India. Now, whether you own them or not is a separate matter. But they are there in our market and they trade at 50, 60, 70 PE and all that. Third is, even if you look at our steel companies and all that, we have raw material, this thing, POSCO and all, no iron ore of their own. Everywhere there is some angle. That is not me to defend. It has been there forever. But now look at what the FII, who had a choice to be in India or not be in India, is doing. So look at the box on the right top. It is showing inflows into India and then inflows in other markets, excluding China. Because for some reason, maybe this information they don't get, but Goldman, this is from a Goldman report, this box. So if you see in 2017, India got 8 billion out of total 22 billion that went to Asia. But now look at 2019, India got 14 out of 24. You look at 2020, India got 23. Rest of Asia were 55 billion outflows. It shows 32 outflow because it includes a 23 inflow from India. Look at year to date. This is 1 month old, which I think India has now become 5.5, I think, because there've been outflows of 1.5 billion. But at this point, which was, I think, April end, 7 billion India, 18 billion outflows in the rest of Asia. So the guys of a choice are also coming. And the valuation, at least relative to others, you can see are on mean. Now, in absolute, it will look high because, as we say, interest rate. Now, what to do about that? Then you have to see each company and say whether you like it or not. And as we said, we don't like the companies which are trading at 90 multiple because they should grow 30, 40% for us to believe that they are, but if they are growing below GDP in nominal terms and they were growing, they were trading at 30 multiple before, yeah, we will not also buy them. So it lies in the eyes of the beholder where the valuation is okay or not okay. That is part of the job.
Samir, the next question is on the Indian e-commerce opportunity. There are a lot of IPOs coming. Will the fund look at IPO opportunities pre-IPO, and which I think is a no, but you can clarify that. And also, would you invest in an e-commerce company which will get listed or is listed?
So the thing is that the e-commerce opportunity is large, but unfortunately, unlike the opportunities that we've seen all our lives, these opportunities are not that big, basically because their starting valuations are going to be very high because they are currently funded by financial investors. Mostly why so much money was made in Infosys and TCS and Bharti and Z and whatever is because those companies directly went public without going through financial investors first, who would have delayed their this thing for many years. So for example, right now the total returns, let's say from a stock, come from some initial 5-7 years of very high growth and then some more regular growth. The first 5 years growth has been taken away by uh, private equity investors. Separately, I may say, because I don't like private equity investors, that overall they also don't make much money because they invest in 10 other companies that we don't see because they get blown apart and go to zero. But whichever companies go public have been very successful, and therefore the starting valuations are very high. So when we say a company like Paytm, it plans to come at 25 to 30 billion dollars. Well, you are most welcome to buy. I will not even go for the call, because how much are you expecting to make out of that? If you're buying an IPO and you think it's a great company, if it has to double, triple, it suddenly becomes 100 billion. We don't have $300 billion companies in our country. But for Zomato and all, the starting will be very attractive, I think, but it depends on how far they take it. So it depends. But generally, India cannot handle 50 and $100 billion companies, which means if you come at 25, 30, and you're at best going to double, which may, in a few weeks, it may happen first, and then they never go for the rest of their life. Who knows? But generally, it is not, it's a good opportunity, but the valuations will be high on listing. One question here is, how come we have only outperformed by 4% and not more? So right now it is 6%, but our goal is not goal. It's only practical to outperform by 5-6%. And we are not investing in 90 companies. We are saying we wish we had those. But in this, suddenly you'll come across a Bharti that we own, which for 1 year is flat, and something else will happen. And the index has a very high small cap component, and we are in the middle of the biggest bull run in small cap, and our fund is not a small cap fund and all that. But if we can outperform by 6% per annum, we'll be blessed, and currently we are blessed. But we would love to outperform by more, but first is to outperform. And that, particularly in very strongly rising markets, is even more difficult because suddenly commodity stocks are tripling, suddenly small caps are tripling. So the thing is more, as we showed in our award, this thing, that if you can outperform for a few years, you beat everybody, because we have seen, look at the heroes who started mid-cap funds in 2017. I don't want to give their names, but 2017 was the biggest bull run for mid-caps, and these AIs raised thousands of crores, and their NAVs were half of that till 5-6 months ago, and now again they maybe got to 9 rupees. So there are phases for different strategies, and we want to be in no strategy. We want to be broadly up there in every phase, and once in a while you may be number one, but over 2-3 years you become, because the churn at the top is very high. How do we know that? From 1990s, see the funds that were at various times the biggest funds of India. First it was Morgan Stanley and Vinod Sethi, then it was HSBC and Sanjeev Duggal, then it was our friends from HDFC in between, and then slowly their performance averages down because of taking narrow strategies or narrow preferences of the fund manager, which work in certain phases. Then in between, you'll have these small cap guys going up 100% and then not being able to meet their redemptions in the next cycle when they fall. To survive is to win in our business.
Another one, Samir, here is what's a market cap composition?
Market cap is there. Actually, our market cap is quite high because of the strategy choices. Because in the sense, when we say that, we like private sector financials, and so here it is. Now, this is as per the definition of SEBI. Whatever, I don't know exactly what they define small cap, but for example, we own Westlife, which is $1 billion market cap. So maybe that is the one in the small cap category. But generally speaking, because we like IT pharma and we like private banks, and we like consumer. Mostly these turn out to be at least largish companies. And that's what I was saying. The NSE 500 also, we have it, now we have it, doesn't matter. Because the comparison is with others, not so much with what we chose as our this thing. Yeah, what is the next question? Sorry. Are NRIs allowed to invest in AI with repatriation benefit? Yes, they are allowed. What is your style of investing? GAP, growth, value, quality? Look at it that I am MBA, went to Wharton, blah, blah, blah. And I know so many fund managers who manage global funds. They are investing in 50 countries. Then some of them have become hedge fund managers. So they invest in 50 countries in equities, then they buy commodities. And I'm such an idiot that I can't buy growth and value and quality and turn around in one fund in one country. So we have no such thing, because we are better than this to say, I will invest in one single country, India, whose weightage in the world is 0.5%. And I am too lazy to even do too much work there. So I will buy only highest quality and buy 10 stocks. So I'm a quality investor. No, it is whatever at a bottom up level appeals to us. It could be a company that is having very bad ROE, but is a turnaround. Or it could be a very good company going through a certain trouble, or it could be a good company doing well. All these are whatever makes sense within the way we have constructed our philosophy, that we would rather uh, reject than accept. My logic is that the highest conviction is in things that you don't do. Your highest conviction is not in things that you do. So let me explain in layman's language. Let us say you want to marry a girl and you go on a date and you don't like the girl. You say not interested. That is your highest conviction. Your highest conviction is not in the girl you will marry. Why? Because once you went the first time and you did not say reject. Reject means highly convinced, not for me. You say, oh, now I want to meet her a second time. Oh, now I want to meet the family. Oh, now I want to meet the brother. Oh, now I want to see their house. So you're not convinced. Then you got to a certain level of conviction and you said, okay. But your highest conviction was what you did not do. Highest, for example, some investors may say, I have a 50-point checklist. Or Warren Buffett said, I read 50 years of annual reports of IBM before he bought IBM. And nobody asked him that why last year when you had read 49 annual reports, you were not convinced. Because he was not. So the point is, in all of these things, certain that philosophy is there, but not this whether it is growth and garb or value, and who knows. We have no idea. Okay, what was your question, sir? Yeah.
Yeah, there's another
First of all, why
Q&A
your
box.
questions are different from my questions, or are
So
you?
there's a Q&A window. So
There's another window. Acha, I'm seeing the chat window. Okay, I have
So
a
there's a
very
Q&A. So
Okay,
I'm picking up from there. So
okay.
those are now tricky ones. So
Acha.
so
I like tricky ones. Yeah.
okay. Next is a little more simple. But what do you think? Do you think India is at an inflection point? Because every time you see an economy going from a $2 to $5 trillion size, do you think the stock markets also reward and the countries are at an inflection point, etc.?
No, I don't believe any of this bull that to buy stocks in a market, I have to first convince myself that this is the biggest event ever and God knows what will happen. If it happens, we will take it. It's not that if suddenly India does very well and the markets are going 30%, I'll say, no, I was only expecting 14% because I said in this seminar, so I should sell. But the point is, we don't need to believe all this to say that we should be investing in equities. So my logic is, if you can broadly say that equity is better than debt, equity is better than whatever else, which I believed all my life, you're not going to borrow, neither are we asking you to borrow from InCred to invest in the fund. So you will anyway invest because it is better than other things. If it becomes much better, great. But we don't need to sell to others. This is the 2003 to 2008 period bull. Anybody knows whether it is 2003 to 2008. But if it gives 14% return, what a great return also. No? It doesn't have to be 2005 to 8. But if it becomes, we'll be delighted. And I also don't believe this 2 trillion to 5 trillion because it is per capita. We as a country suddenly choose in death cases, we will choose per capita. In this, we will choose in absolute. And I don't believe all that. And neither do I have to believe all that. And neither do I believe super bullish stories on anything because normal bullishness should give you returns. Extra bullishness we will take with pleasure. So, no, this is not 2003 to 8. This is not Junjunwala. This is normal stuff.
I think we are done with most questions and queries.
There's one question
Yeah, Devi,
on the
yes.
benchmark, Samir. So if you can, why didn't we choose
So we chose, why we chose? We were too busy to think too much. So
Yeah,
we just chose saying that, what is the market, what is the benchmark for a multi-cap or whatever it's called? Who knew all these things? So now some people say that you could have chosen BSE 200. But in the end, plus minus half to 1%, it doesn't matter. And the second thing is in the end, we will be compared with what these other PMS guys do who have 2-year history and 1.5-year history and all that. And that we will see in the market, but whether I beat my index by 1% less than is may matter to some theoretician. It doesn't overly matter to me. But in the end, we are not definitely a Nifty. In the sense, we are not that large cap because we are willing to go mid cap and small cap. So the choice could only have been between BSE 200, let's say, and NSE 500. Now, I was too busy to even focus on this at that point of time when we did it, and now it's there. Doesn't matter to anybody.
Great. So I think we've covered all the questions. It was a very informative session.
Thank you.
We hope to get most of these clients in and participate and allocate to your fund.
Sure. Thank you very much, everybody.
Thanks.
All we commit is sincere work and super skin in the game. Thank you very much. Thanks.
Thank you, everyone, for your time and attention.
Thanks,
Thank you.
everyone.